A pawn shop looks like a crowded secondhand store. Guitars on the wall, jewelry behind glass, power tools with somebody else's name scratched into the case, old game consoles, watches, cameras, and enough extension cords to connect a small city. But the merchandise is not the strange part. A pawn shop does not lend against your promise. It lends against the object already on the counter. The strange part is that a pawn shop can hand someone cash without checking a credit score, without asking for a pay stub, and without giving itself the right to chase that person for repayment. At FirstCash, the largest public pawn operator in the United States, the average American pawn loan at the end of 2025 was just $312. If the customer does not repay it, the shop does not send collectors. It keeps the object. That sounds like the safest loan in finance. The borrower either returns the money or the lender gets something valuable instead. It is not that simple. Because when the customer disappears, the risk does not disappear. It changes shape. A loan becomes a ring that may be fake, a television that may be obsolete, a guitar that may sit for 9 months, or a gold bracelet whose value moves before the shop can sell it. A pawn shop does not eliminate credit risk. It converts credit risk into appraisal risk, inventory risk, security risk, and regulation. And by the end of this video, you will understand why a public pawn chain can earn a monthly loan yield near 14%, why a mature location can tie up well over $500,000 in loans and inventory, and why the best pawn shop owner is not really a lender or a retailer. The best owner is a professional buyer of uncertainty. Start with the legal transaction, because this business makes no sense until you understand what the customer is signing. A customer walks in with an object. The shop estimates what that object could realistically sell for, offers a loan worth only a fraction of that estimate, and keeps the object as collateral. The customer receives cash and a written pawn ticket showing the amount financed, the service charge, the maturity date, the amount required to redeem the property, and the annual percentage rate. The customer has 2 choices. Choice 1, return before the deadline, pay the principal plus the disclosed charge, and take the object home. Choice 2, do nothing. In an ordinary consumer loan, doing nothing creates late payments, collections, damaged credit, and possibly a lawsuit. In a traditional pawn loan, the borrower has no legal obligation to repay. The shop's only claim is against the pledged property already sitting in its secured storage area. Once the loan term and any legally required grace period expire, the item becomes the shop's inventory. The customer can walk away. The shop cannot walk away from a bad valuation. That is why pawn loans are called non-recourse. The lender cannot pursue the customer beyond the collateral. It also means the shop is underwriting something completely different from a bank. A bank asks, will this person repay? A pawn shop asks, if this person does not repay, can I turn this object back into cash? The term usually runs somewhere between 30 and 90 days, followed by a grace period that depends on the state and local rules. Some jurisdictions permit extensions or renewals when the customer pays the accumulated charges. Others impose different notice, storage, reporting, and fee requirements. And the state matters enormously. Florida, for example, allows a total pawn service charge of up to 25% of the amount financed for each 30-day period. A $200 loan at that maximum would cost $50 to redeem after 1 month. Annualize a 25% monthly charge, and the disclosed rate looks close to 300% before calculation details. The customer is not necessarily borrowing for a full year, but the annualized number shows how expensive repeated renewals can become. At the same time, the product is structurally different from a payday loan. There is no automatic debit from a bank account, no collection call, and no remaining balance after the collateral is forfeited. The maximum financial loss to the customer is the pledged item and any fees already paid. That difference is the entire reason this industry still exists. The shop is serving a transaction too small and too unusual for most banks to process profitably, while taking an object instead of a promise. Not every pawn shop is the same business. The first type is the jewelry-heavy collateral lender. It may occupy a relatively small storefront, but most of the economic value is concentrated in rings, chains, watches, diamonds, and precious metals. It needs secure storage, specialized employees, controlled access, and the ability to make quick decisions about items that look similar but may differ in value by thousands of dollars. The second is the full-line neighborhood pawn shop. This is the version most people picture. Tools, electronics, musical instruments, appliances, sporting goods, and jewelry. It needs more floor space and much more storage. The average loan is smaller. The inventory is bulkier, and technology becomes obsolete faster. The third is the high-end asset lender. This shop deals with luxury watches, designer goods, art, collectible vehicles, and other expensive collateral. Fewer customers can produce a much larger loan book, but one bad authentication decision can erase the profit from dozens of successful transactions. For this episode, we are focusing on the ordinary American full-line shop with a meaningful jewelry business, because that is the most useful model for understanding the industry. The expensive part is not the neon sign. It is the cash trapped in loans and inventory. And the first surprise is how much capital it takes before the shop can look ordinary. The neon sign is cheap. The cash trapped behind the counter is not. Look at the public operators. At the end of 2025, FirstCash had about $450.5 million in U.S. pawn loans and $286.1 million in U.S. inventory across 1,207 locations. That works out to roughly $610,000 of loans and inventory per store at that moment. EZCORP showed an even larger store-level asset base. Its U.S. segment ended fiscal 2025 with about $233.8 million in pawn loans and $185.6 million in inventory across 545 stores, roughly $770,000 per location. Those are mature chain averages, not a promise of what a new independent store needs on day one. But they reveal the central problem. A real pawn shop is not just shelves and counters. It is a pool of capital continuously moving between cash, loan tickets, secured storage, and retail inventory. A serious leased location might require a modeled budget like this: $250,000 for build-out, display cases, a vault or large safes, cameras, alarms, reinforced storage, computers, point-of-sale software, and the ordinary cost of turning a blank retail box into a secure financial business. Another $100,000 for opening merchandise, because an empty pawn shop looks like a closing pawn shop. $450,000 as the initial loan fund. That is the cash actually handed across the counter and locked into outstanding pawn tickets. $150,000 for payroll, rent, insurance, utilities, professional services, and the months it takes to build repeat traffic. Then another $100,000 for licensing, deposits, contingencies, repairs, and all the things that were not included when the first estimate was prepared. That puts the modeled capital requirement around $1.05 million before buying the real estate. A smaller operation can open for less, but it also starts with a smaller loan book, fewer items, less customer traffic, and less room to survive a bad valuation. Buying an existing store may reduce the ramp-up problem because you acquire an active customer base, outstanding loans, inventory, trained employees, and local history. But then the seller knows exactly what those things are worth. You are not just buying fixtures, you are buying a functioning circle of cash. That circle is the actual asset. Now take one transaction. A customer brings in a piece of jewelry that the shop believes could sell for $1,000 in a normal retail environment. The shop does not lend $1,000. It might offer $400. That gap is not greed by itself. It is the shock absorber. Default is not the end of the loan. It is the beginning of a retail problem. The shop has to assume the customer may never return. It has to account for the possibility that the item takes months to sell, needs repair, attracts negotiation, is misidentified, becomes subject to a legal hold, or falls in value. The loan must sit below the shop's conservative estimate of recoverable value. Suppose the 30-day service charge is 20%, purely as an illustration. The customer receives $400 and needs $480 to redeem the item after 1 month. Outcome 1. The customer returns. The shop receives its $400 principal back plus an $80 service charge. The same $400 can now be lent again. That is the clean outcome. The business earns a fee without needing to find a retail buyer. Outcome 2. The customer does not return. The jewelry moves from collateral storage to inventory. In the accounting used by large public operators, the principal of the unpaid loan becomes the item's inventory cost. In this example, the shop now carries the piece at $400. If it sells for $700, the shop generates $300 of merchandise gross profit before payroll, rent, security, insurance, and every other expense. So the shop appears protected either way. If the customer pays, earn the fee. If the customer does not pay, sell the collateral. But change one number and the beautiful machine breaks. Suppose the item does not sell for $700. Suppose the realistic price is $350. The shop already advanced $400. Now the secured loan has become inventory that cannot recover its own carrying value. Add employee time, storage, online listing fees, card processing, shipping, and markdowns, and the loss gets worse. That is why the loan decision is the most important moment in the whole business. The customer sees a negotiation about how much cash an object is worth today. The shop is making a prediction about what an unknown buyer will pay later after an unknown amount of time under unknown market conditions. You are not underwriting the person. You are underwriting the exit. Public pawn companies report yields that would look absurd in ordinary banking. EZCORP's U.S. pawn segment reported an average monthly ending loan balance per store of about $399,000 in fiscal 2025 and a monthly average yield of 14% on outstanding pawn loans. Apply 14% to a $399,000 average balance, and the rough monthly pawn service charge engine is about $55,900 before differences in timing, collection of accrued charges, and accounting. Annualized, the theoretical fee stream is enormous relative to the principal outstanding, but that is not the same as profit. First, the shop needs enough employees to value items correctly, process transactions, protect the building, manage renewals, prepare inventory, and sell merchandise. Second, the capital is constantly tied up. Third, the store must support a physical retail operation even when the loan side is slow. Fourth, the fee structure is limited by state law and may be reduced for certain protected borrowers. And, most importantly, the shop cannot simply maximize the loan amount and the fee at the same time. A larger loan creates more service charge revenue if it is redeemed, but it also reduces the safety margin if the item is forfeited. A manager who consistently lends too little loses customers to the shop across town. A manager who consistently lends too much can report beautiful loan growth right up until the inventory reaches the sales floor. The best loan is not the largest possible loan. It is the largest loan that still leaves a reliable exit. The display case is not the main product. It is the backup exit. That balance is hard to teach because it depends on thousands of individual markets. A cordless drill may sell quickly in one neighborhood and sit for 6 months in another. A luxury watch may be more liquid online than locally. A game console can lose value after a product announcement. A musical instrument may be worth more in August than in January. Gold has a visible market price, but the retail piece still has purity, weight, condition, design, and transaction costs. The shop is pricing all of that in minutes while the customer is standing at the counter. A pawn shop earns money from several directions. The first is pawn service charges, the fees earned while the loan remains outstanding and when it is redeemed or renewed. This is the most attractive revenue because the principal returns and no retail sale is required. The second is merchandise sales. Inventory arrives from forfeited collateral and from items purchased directly from the public. The shop cleans, tests, prices, displays, negotiates, and eventually sells it in the store or online. The third is precious metal and jewelry scrap. Some pieces are worth more as metal than as retail jewelry. Large operators sell quantities of gold, silver, and other recoverable material into wholesale markets. That creates a different margin, exposed more directly to commodity prices. The fourth includes layaway, direct purchases, online sales, and selected ancillary services. The exact mix varies by operator and state. The public numbers show why the shop cannot choose between lending and retail. It needs both. In 2025, FirstCash's U.S. pawn segment generated about $555 million in pawn loan fees and more than $1.04 billion in retail merchandise sales. The retail sales carried a 42% gross margin. The segment produced a 26% pre-tax operating margin after store expenses and depreciation before unallocated corporate costs. EZCORP's U.S. segment told the same story through different accounting. In fiscal 2025, it generated about $351.5 million in pawn service charges, $475.3 million in merchandise sales, and $85.7 million in jewelry scrap sales. Merchandise gross margin was 37.1%, and U.S. segment contribution reached about $200.2 million. The lending side creates the inventory pipeline. The retail side recovers capital from forfeited loans. The direct purchase side fills useful gaps in the showroom. The scrap side provides a final exit for items that make more sense as material than merchandise. This is not a bank with a random store attached. It is a bank whose loan recovery department is a store. A perfectly real guitar can still be bad collateral if nobody nearby wants it. Walk through a pawn shop, and every item represents a capital allocation decision that has not finished yet. The television on the wall may be a forfeited $180 loan. The guitar may have been bought directly for $250. The gold chain may be held for retail at $900, but could be scrapped if it does not sell. The power tool may have been marked down twice already. This is why inventory age matters. FirstCash reported that only 1.8% of its U.S. inventory at the end of 2025 was more than 1 year old, and its inventory turned about 2.8 times over the trailing year. Those are signs of aggressive inventory discipline. An independent owner who refuses to mark down a bad purchase can turn the showroom into a museum of old mistakes. Jewelry dominates the economics because it stores a lot of value in very little space. At FirstCash, jewelry represented 73% of U.S. pawn collateral at the end of 2025. At EZCORP, it was 68% of the U.S. loan portfolio mix. Compare a gold chain with a used refrigerator. The chain fits in a small, secure envelope. It has a global commodity floor. It does not become technologically obsolete. It can be sold as jewelry, sold online, or liquidated for material value. The refrigerator occupies half a room, costs money to move, can hide mechanical problems, and may be worth less every month it sits. This does not mean general merchandise is bad. Tools, instruments, electronics, and appliances create traffic and retail demand. But they require space and fast pricing decisions. A pawnshop owner can be technically correct about an item's value and still lose money, because the item is not liquid in that location. The most dangerous inventory is often not counterfeit or stolen. It is perfectly real merchandise that nobody nearby wants at the price you need. Now, the other side of the ledger. Labor comes first. A pawnshop needs people who can make lending decisions, recognize categories, document transactions, manage cash, handle retail customers, monitor inventory, and follow state rules. The skill is not just knowing what something is worth, it is knowing how quickly that exact location can turn it back into cash. In pawn, compliance is not paperwork around the business, it is part of the product. Then, rent. Utilities, repairs, insurance, advertising, card fees, banking fees, software, security monitoring, safes, cameras, alarms, and the cost of holding a large amount of cash and portable merchandise in one building. EZCORP describes store expenses as including labor, utilities, supplies, banking fees, rent, repairs, advertising, property taxes, insurance, and regional management. In its U.S. segment, those store expenses totaled about $339.4 million in fiscal 2025. Then comes compliance. Pawn is local finance, retail, secured storage, and law enforcement reporting inside the same transaction. The shop may need a state license, a separate license for each location, local permits, employee licensing, approved forms, annual reports, inspections, and electronic transaction records. Texas licenses and regulates pawn shops through the Office of Consumer Credit Commissioner. It requires written agreements and conducts routine examinations of most shops on an approximately 18-month cycle. Florida shows how operational the rules can become. The shop must create a detailed transaction form, capture identification and item information, deliver transaction records to law enforcement, and hold purchased goods in unaltered condition for 30 days. Law enforcement can place qualifying property on a written hold for up to 90 days unless a court extends it. That means an item can be economically valuable, legally unsellable, and physically occupying secure space at the same time. And although television has trained people to associate pawn shops with stolen property, the more useful business lesson is simpler. Every item must have a document trail because the shop's collateral is portable, resaleable, and sometimes disputed. Compliance is not paperwork around the business. Compliance is one of the machines that makes the inventory saleable. A single independent store makes each decision with local knowledge. A chain makes the same decision with data from hundreds or thousands of stores. FirstCash says its systems can show employees recent selling prices for similar merchandise, prior transaction history, pawn loan yields, inventory age, and store-level activity in real time. That reduces the chance that one employee is valuing an object from memory or from an optimistic online asking price that nobody has actually paid. Scale also creates more exits. An item that is slow in one neighborhood may sell in another store. A chain can move inventory, compare regional demand, centralize online sales, negotiate insurance and software, train specialized employees, and spread corporate compliance costs across a larger loan book. This is why the industry can be fragmented and still reward consolidation. The local relationship matters, but the back-end data becomes more valuable every year. As of March 2026, FirstCash operated 1,207 U.S. pawn stores. Its U.S. pawn receivables were up 21% from the prior year. Pawn loan fees were up 14%. Retail sales margin reached 44%, and the segment's pre-tax operating margin reached 29% for the quarter. That does not mean every independent owner can copy those margins. Public chains have mature locations, acquisition experience, purchasing data, corporate systems, and access to capital that a new shop does not. But the numbers prove the model itself can be highly profitable when four things happen together. The loan book is large. The yield is legal and consistently collected. The inventory turns quickly at a healthy margin, and operating costs grow more slowly than the gross profit pool. Miss any one of those, and the same storefront can look busy while producing very little cash. This business has an unavoidable moral and regulatory tension. A 20% or 25% charge for 1 month is expensive credit. Annualized, it produces a rate that would be unthinkable on a mortgage or a normal credit card. A customer who repeatedly renews a small pawn loan can pay fees approaching or exceeding the original principal while still needing to pay the principal to recover the item. That is the strongest criticism of the model. The strongest defense is that the shop is not making a $30,000 unsecured loan. It may be making a $150 or $300 non-recourse loan immediately without a credit investigation, while storing and insuring the collateral and accepting the risk that the item is worth less than expected. Most banks do not want to underwrite that transaction at any price because the administrative cost is too high relative to the loan. Both things can be true. The product can be useful and expensive. The customer can understand the transaction and still have poor alternatives. The shop can provide real liquidity and still require strict rules. Federal law creates an important example. The Military Lending Act caps the military annual percentage rate at 36% for covered active duty service members and certain dependents, along with additional protections. In July 2025, FirstCash and several subsidiaries settled a CFPB lawsuit alleging that the companies had made non-compliant pawn loans to covered military borrowers. The settlement was entered without adjudication of the disputed facts. The defendants did not admit the allegations beyond jurisdictional facts. The order required an initial $5 million redress account, additional redress if needed, and a $4 million civil penalty. The process covered tens of thousands of loans identified by the Bureau for review. A bad economy does not guarantee a good pawn year. Liquidity is what matters. The lesson for an owner is not that pawn lending is illegal. The lesson is that a fee permitted by state law may still be restricted for a protected federal borrower, and one failure in customer identification or system controls can turn a small dollar transaction into a large compliance problem at scale. There is a common idea that pawn shops thrive whenever the economy gets worse. Sometimes demand for short-term liquidity does rise, but the business is more complicated because it has customers on both sides of the counter. Borrowers need cash. Retail customers want discounted merchandise. The shop needs a steady balance between loans being written, loans being redeemed, collateral being forfeited, and inventory being sold. In 2020 and 2021, government stimulus created a useful demonstration. EZCORP reported that pawn loan demand fell sharply as stimulus payments helped customers redeem loans. Pawn loans outstanding dropped, pawn service charge revenue fell, and inventory declined because fewer customers needed to leave items behind. At the same time, retail margins improved as consumers arrived with cash and bought merchandise. The same event hurt one side of the business and helped the other. That is the structural paradox. A pawn shop does not simply profit from hardship. It profits from movement between temporary cash need and recoverable collateral. Too little customer liquidity can reduce redemptions and flood the store with inventory. Too much liquidity can shrink the loan book and the fee stream. The ideal environment is not disaster. It is constant, manageable financial friction. Now answer the real question: what can one store earn? These are modeled scenarios, not an industry average, and not a promise. They use public chain economics as a benchmark, but assume an independent leased location with less scale. Initial capital deployed, about $1.05 million. That includes $250,000 for build-out, security, and systems, $100,000 of opening merchandise, a $450,000 pawn loan fund, $150,000 of working capital, and $100,000 for licensing, deposits, and contingency. During a mature year, the store maintains an average pawn loan balance of $350,000. At an average monthly realized yield of 12.5%, pawn service charges produce roughly $525,000 over the year. The store also generates $800,000 in merchandise sales at a 38% gross margin, producing $304,000 of merchandise gross profit. Add about $30,000 of gross profit from scrap and other activities. The combined gross profit pool is approximately $859,000. Now, subtract $610,000 for payroll, including a market rate manager or owner's salary, rent, utilities, insurance, security, software, marketing, professional fees, repairs, shrink, and depreciation. Store-level pre-tax operating profit, roughly $249,000 before income taxes, debt principal payments, and owner distributions. On a simplified pre-tax basis, that implies a little over 4 years to recover the original capital before financing costs and taxes. That is an attractive small business, but it requires more than $1 million, a mature customer base, daily operating attention, and disciplined valuation. Same building, same neighborhood, same $1.05 million starting capital. But the manager competes by offering more cash on every item. The average loan balance grows quickly, and the owner celebrates because service charge revenue initially rises. Then forfeitures arrive. The store has advanced too much against electronics, tools, and jewelry. Inventory swells. Merchandise sales reach $750,000, but repeated markdowns pull the gross margin down to 27%, generating only about $203,000 of merchandise gross profit. The average loan balance falls later in the year as cash becomes trapped in unsold inventory. Pawn service charges finish at $365,000. Scrap and other gross profit add $20,000. Total gross profit, about $588,000. The best pawn shops are not aggressive lenders. They are disciplined buyers of risk. The expenses do not fall quickly. The store still needs employees, rent, cameras, insurance, software, utilities, and compliance. Operating costs finish at $600,000. The store loses roughly $12,000 before interest and taxes. More importantly, another $150,000 or $200,000 may now be trapped in aging inventory that has to be marked down to become cash again. On paper, the owner made more loans. In reality, the owner bought too much merchandise from the future. That is how a secured lender loses money without a traditional loan default. A pawn shop looks like retail because the public sees the display cases. The economics begin before anything reaches the display case. The store advances cash against an object, prices the probability that the customer returns, and creates two exits. Redemption produces a fee. Forfeiture produces inventory. The whole business depends on making sure the second exit is still open when the first one fails. That is why the pawn ticket is more valuable than the price tag, why jewelry is more attractive than bulky merchandise, why data is replacing intuition, and why the biggest risk is not the customer walking away. The customer is allowed to walk away. The real risk is discovering that the object left behind cannot. A pawn shop is a bank with a display case. And the display case is where every lending mistake eventually has to explain itself.